Hey, hello investors and future investors. Welcome to the channel. For today's video, I'm going to be showing you an option strategy that can be used if you're new to options trading. Now, it does not matter if you know about the fundamentals, if you know about the technicals, or even if you could read a chart, none of that matters. By the end of this video, you should be able to go ahead and practice this particular option strategy in your portfolio, and you should be able to make some steady income. Now, if you're new to options trading or you're trying to use options trading in order to make some additional income to supplement your regular 9 to 5, then you so happen to stumble onto the right video. Welcome to Investment Gains. Let's jump right into it. Welcome back, investors and future investors. My name is Tim, and on this channel, I show you how I use my portfolio in order to make consistent income. For today's video, I'm going to be showing you a simple option strategy that anyone could use if they're new to options trading, or even if you only have a couple $100 in your portfolio. This option strategy is going to be an income generating strategy. So, what that means is that as soon as you decide to execute this strategy, you will be receiving some kind of income. We will go ahead and get down and dirty with options, meaning I'm going to give you a step-by-step walkthrough in order for you to see what I'm doing, and most importantly, in order for you to be able to follow along with us. Now, this is going to be a two-part series, so this is going to be part one. Depends on the response I get from this video, I'll decide if I'm going to go ahead and make part two. If you guys want to see a part two after watching this video in its entirety, just go ahead and hit part two in the comments below. Now, for today's video, we're going to be using none other than the Spider ETF, or the ticker symbol is going to be SPY. Now, let's go ahead and we're going to go ahead and get down and dirty with options right away. So, in order to do this option strategy, let's go ahead down here and go to Trade SPY Options, and that's going to go ahead and open up the options chain. Now, if you're new to options trading or you're new to my channel, this area down here in its entirety is what's known as the option chain. Now, what the option chain does is that the option chain gives you enough information in order for you to make a decision before entering any options trade. Now, speaking of entering into options trade, there's always two requirements I have for my viewers and also my subscribers. Requirement number one is going to be always make sure to do your own due diligence before entering any options trade. What might work for my portfolio, quite frankly, may not work for yours. The second requirement I always have is to make sure to have an exit strategy before entering any options trade. That way, if the trade decides to go against you, then you know how to get out of it. And we will be going through an exit strategy in this video. So, without further ado, let's go ahead and get this done. Now, you guys need to pay attention. I'll be as detailed and as thorough as I possibly can. So, step one, we're going to go ahead, we're going to go to sell. Step two, we're going to go ahead and go to put. Now, this option strategy works particularly well if you're using some sort of ETF. Now, the best ETFs to do this option strategy is going to be the Spider ETF, which is the one we're using right now, which is SPY, the QQQ, or the IWM. So make sure you make a note of that. The best ones, the IWM, the QQQ, and the SPY. Now that we have sell and we have put, we're going to go ahead and choose our strike date. The strike date I will be choosing is going to be July 7th. The reason why I'm going to go ahead and choose July 7th is that we're going to do what's known as weekly options. Meaning we're just going to give ourselves 7 days, or we're going to make sure it expires every week. So we're going to go ahead to July 7th. That's one of the other reasons to use only ETFs, because most of them now have daily expirations. So not because you're able to trade every day means that you can go ahead. You need to also be aware of what's known as the PDT rule. I'm going to go into that a bit later on in the video, because if you are going to do this option strategy, it means that you have a small account. Now that we have sell and we have put, we have chosen our weekly strike date, we're going to go ahead and we're going to choose the strike price. Now remember, I did promise you, even if you have no technical ability, you don't know the fundamentals, you could still do this option strategy. And this is how. What you're going to be doing is that you're going to be looking for what's known as a chance of profit right here. As you can see here, right where I'm circling. So the chance of profit you're going to be looking for is an 80% chance of profit or higher. Now, the closest one to the 80% chance of profit is going to be this one here with a 79.87%. Now, The strike price that corresponds with that is going to be the 611. So we're going to choose the 611 strike price, which gives us an almost 80% chance of profitability. And we're going to go ahead and we're going to get paid. Now, this is the first leg of a two-leg option strategy. Now, this first part, we're going to get paid. The reason why we're going to get paid is because we're going to be doing a sell contract. Once you sell something, you always receive some kind of compensation. Now, the amount you're going to be receiving is going to be $1.49. That's in options term. In the real world, this is going to equate to $149. And that's simply because each option contract does contain 100 shares. So you simply multiply your $1.49, which you're going to receive, multiply that by 100 shares, and that should give you $149. Now, what we're going to do, we're going to go ahead to the second leg of this option strategy. We're going to flip the switch right now. We're going to implement buy while still maintaining the put and still maintaining our weekly expiration date. Now, pay close attention because this is going to be switched up as the video continues. What you're going to do now is that you're going to go ahead and choose the strike price immediately below your sell put. And that's going to correspond with the 610 strike price. We're going to go ahead and select that. Now, this is the second leg of this two-leg option strategy. Now, for this second leg, we're going to be buying. And because we're buying, we have to pay. The amount we're going to have to pay is going to be $1.32 or $132. I did promise you that this is an income-generating option strategy. And once you decide to execute it, you will be receiving some kind of income. The income you're going to be receiving is going to be the difference between your $149 right here and your $132 right here. That money you're going to receive right away. This option strategy is none other than the put credit spread. Now, the put credit spread is an income generating option strategy, and this option strategy is perfect if you're new to options trading or particularly if you're trading with a small account. And here's why. Let's go ahead now to continue. Let's go to review order, and I'm going to walk you through the trade. Now, stay to the end of the video. I will show you how to get out of these trades. I will show you the exit strategy. Now, so once you decide to go ahead and do this trade, you're going to be receiving income right away. The amount of money you will be receiving is going to be $18.92. For the purposes of this video, we're going to go ahead and round it up. So let's just say $19. That's going to make the math a lot easier. So you will be receiving $19. One of the main criteria in order for you to do the put credit spread is that you will need to leave a collateral. The collateral you're going to have to leave in this case is going to be $100. Now, don't feel phased by receiving only $19. Try your best not to focus on the nominal value of your returns. Instead, focus on your percentage return. Receiving $19 and only putting up $100 for collateral, that's going to give you a return of 19%. Now, 19% return in just 1 week is an extremely high and lucrative return. So that's a very, very good trade right there. Now, if you think 19% return is too high and is too risky, then here is one thing you can do in order to mitigate your risk. So what we're going to do now, we're going to go ahead and we're going to switch up our strike prices. I did tell you to pay attention. Now, in order for you to get your collateral right here, which is $100, that's dependent on your spread. Your spread is going to be the difference between your two strike prices. So in this case, it's going to be 611 and 610. You're going to subtract 610 from 611. That should give you $1. You are dealing with a leverage product here, which is options trading. So you simply multiply your $1 by 100 shares, and that's going to give you $100 right here. So in order for you to make this trade a little less risky, here's one thing you could do. We're going to go ahead, we're going to unselect this now, and we're going to increase our spread. So instead of going with the 610, which is a dollar wide spread, we're going to increase it now to a $2 wide spread. So instead of the 610, we're going to go to the 609. Let's go ahead, we're going to select that. Now, before anything, let's go ahead and go back in order for us to refresh this. So we're going to go back, then we're going to hit review order one more time so it can refresh itself. Okay, and voila. Now that you made that slight adjustment, here's what's going to happen. The amount of money you're going to receive is going to increase. So instead of receiving $19, you're now going to receive almost twice as much as that, which is going to be $36. However, your collateral is going to go up. It's going to go up now to $200. And the reason for that is now because you're using a $2 widespread as opposed to previous where you use a $1 widespread. Now, that is one way you could reduce the risk. The reason why this reduces your risk is because in order for this trade to go against you, this share price right here needs to drop all the way below the 609 in order for you to lose this trade. As opposed to the previous strike price where we had at the 610, the share price has to fall below the 610. Now, common sense would dictate that it's a lot easier for the share price to go past 610 as opposed to 69 because it has to go past the 610 first before it hits the 609. So that's one option you could use in order for you to mitigate your risk. Now, here's another one you could use. Let's go ahead and clear this out once again. Now, when we started off, I asked you to look, even if you have no options knowledge, your criteria for choosing your first strike price is going to be an 80% chance. Another thing you could do to lower your risk is going to be, let's get rid of this, is going to be to increase your chance of profit. So now what I'm going to do is that I'm going to go ahead and increase my chance of profitability. So I'm going to be going with an 85%. Remember, previously we went for 80% chance. Now, the corresponding strike price for this 85% chance is going to be 608. So let's go ahead. We're going to clear that one. Then now we're going to go ahead to buy again. We're going to go to put while maintaining our exact same strike date. And we're going to select the strike price right below. We're going to be doing a dollar widespread. Hopefully you guys are following me still. So that's going to give us the 607 strike price. We're going to go ahead and select that. Now we're going to hit continue. We're going to hit review order one more time, and this is going to be the result. Now, for this trade, you're going to be receiving a lot less money, which is going to be $13. So your percentage return has decreased from 19%, which you would have received previously, to 13%, while your collateral still remains the same because we're still going to do a dollar widespread. Now, this is how this reduces your risk. Previously, you chose a chance of profitability of 80%, and now you choose one of 85%. 85% give you a way higher chance of the trade going against you than does 80%. So right now, those are two ways that you can do in order for you to mitigate your risk. Now, how does this trade work? So in order for this trade to go in your favor, in order for you to win this trade, come expiration date of July 7th right here, all you need to happen is for this share price right here to stay above the 608 price right here. Now, the difference between the 617 here, let's round it off to 618, and the 608 is going to be about $10. So the share price literally needs to drop to $10 in order for this trade to go against you, and it needs to drop an additional $1 to go below your 607 right here. Now, once the share price stays above your 608 here, that means you're going to win the trade. Once you win the trade, you get to keep your initial credit. This credit here is yours to keep no matter how the trade goes. Whether the trade goes in your favor or against you, this credit is always yours to keep. So you get to keep your credit here. And in addition to that, you're going to have your $100 right here released back to you. So now you're able to go ahead and do this trade again. Now, the other way this trade could go, if the trade decides to go against you, if the share price of 618 come expiration date of July 7th now falls below your 607 price right here, then once again, you keep this $13 here, but then now you're going to lose your $100. But you don't lose the entirety of your collateral. So the exact amount you're going to lose is going to be your $13 you receive here as your option premium, as your income. You're going to subtract that from the amount of money you left for collateral, which is going to be $100. And that should give you around $87. So the amount of money you're going to lose on this trade is going to be $87. That $87 you're going to lose 15% of the time. This $13 here, you're going to win 85% of the time. This is why you're going to need to choose your chance of profitability based on your own portfolio goals and your risk tolerance. Now, how do you get out of this trade? Well, it's quite simple. Once you're in the trade, you're going to simply open up the trade and Robinhood is going to give you some options, no pun intended. So the options they're going to give you here is going to be close this trade. You should have a green button here that says close, and below that you're going to have another green button that says roll this trade. Now, to be quite frank, I don't support rolling out a option spread. The reason for that, I just don't think it's worth it since it's such little money that you're using. Instead, cut your losses and then go ahead and do this trade again. But I'm just going to show you this so you can learn different ways to exit this option position. So once you go ahead and you're going to hit your roll this position, what Robinhood is going to do is that it's going to close out your current position while simultaneously opening up a new position for you. Now, options rolling is just a fancy terminology that simply means you're going to be closing out one position and opening a new position at the same time. That's option rolling is a very good exit strategy. Now, the other exit strategy you can use is that if the trade is going against you, simply close out the trade, take your losses, and go ahead and do the trade again. Now, if the trade is going against you and you decide to close your losses, you're not going to lose the entirety of your collateral. It's going to be the amount of percentage up or down you are on the trade. Now, if everything I've said in this video makes sense, there's one thing I need you to absolutely listen to right now. Always close your option spreads before expiration. With other option strategy, it's okay to let them go to expiration date. However, spreads is a different beast altogether. So always make sure to close this trade before expiration. If you don't know when the best time to close the trade is, as soon as you open up the trade, go ahead and put in another order to close the trade based on your risk tolerance. Now, if you guys don't know what that is, just go ahead and search your channel for exit strategies. It's going to give you a complete walkthrough of how to close the trade. So there you have it, investors and future investors. If you're new to options trading and you have a very small options account, one of the best option strategies for you to employ is going to be the put credit spread. What the put credit spread does is that it's an income generating option strategy that puts money in your pocket as soon as you do the trade. The other reason why this is extremely good if you're trading with a small account is because the barrier to entry is extremely low. Anyone trading with a couple $100 in their portfolio will be able to go ahead and do this option strategy. Now, of key importance, always make sure you know your exit strategies. The next thing to do, always make sure you stay away from trading every single day. Now, I did mention the PDT rule at the start of this video. PDT stands for Pattern Day Trader Rule. It simply means if you were to be caught trading more than 3 times per week, then your trading account is going to be shut off for a minimum of 6 months. It has nothing to do with Robinhood, it's just an SEC requirement. In order for you to get away from the PDT rule, you simply need to have a cash account. If you are using a margin account, you need your margin account to be in excess of $25,000. Or if you don't have time for any of that, you simply could go ahead and trade every other day. That works as well. I did that when I was growing a small account. So those are 3 things you could do to get away from the pattern day trader rule. Now, if you guys have any question about the put credit spread, let me know in the comments below. So this video is the first part of a 2-part series, and the purpose of this video is to be able to help people that just get into options trading and trading with a small account, help them to make some consistent income. So in order for us to go ahead and do the part 2 of the video, I need some response from you guys. Just go ahead in the comments below and just hit part 2. Now, the put credit spread is a bullish option strategy. If I do decide to go ahead and do part 2 is going to be another income generating option strategy, but this time it's going to be a bearish option strategy that's still going to allow you to get regular income. Now, for those of you that made it to this part of the video, you guys are the real investors and future investors. Go ahead and do me a favor, like the video, subscribe to the channel, make sure to hit that notification bell to get an alert when I post a video. But most importantly, if there's anyone out there you know struggling to grow a small account portfolio, then the right thing to do is to go ahead and share this video with them. We're trying to help as many as we can get away from that regular 9-to-5 job and make income with options. Now, until the next video, keep pushing your investments.